Precious metals, like gold, are often thought of as safe haven assets. Safe havens are assets that investors turn to protect themselves or even profit from periods of market turmoil. However, the dip last week shows otherwise. This little mini recession is showing us that even when the NASDAQ tumbles, gold also tumbles because the dollar is getting stronger as equities fall. But even in spite of that, gold has had an amazing run this year. It's up nearly 26% year to date. So we want to look at and see, can gold keep on running, and how can you get some exposure to gold? Now we're going to be mainly looking at and speculating if gold will go up. Because I mean, really, you aren't looking at gold to, let's say, diversify or hedge your portfolio. You're trying to make some money. Because I mean, be honest, if I told you that gold was going to drop for the next year or so, you wouldn't buy it. But it diversified my portfolio. Yeah, it did. It's a hedge against, let's say the dollar and an inflation rate, interest rates, real rates, instability like a recession. Yeah, that's also true. But is it going to go up? Can we really analyze and take a look at some things and see, are we in the good, effects and market that's amiable for gold to go up? And we should really take a look at this because this is a special market, as we can tell. I would have never thought that, stocks like Peloton or Domino's Pizza or Tesla would have gone on such great runs. This market has a mind of its own. And so why can't these great runs also be applied to gold if we have the same conviction? So today, I just want to focus on the gold trust, the Spider Gold Trust, ticker GLD today. I want to take a look at the prospectus. Now it says, for reference, in the prospectus, the price of the shares of GLD on April 25th, 2012 was $159. So could you imagine investing your money in this ETF and then all these years later, you get to today and you're only up, 20-ish percent? That's, not the greatest long-term hold, I guess, if you think about it, compared to some of the other ways you could be using your money nowadays. I'll expand on that point more later. But in the prospectus, it says that the Gold Trust is an investment trust formed in November 12, 2004. The trust holds gold bars and issues shares in exchange for deposits of gold. The investment objective of the trust is for shares to reflect the performance of gold bullion less the trust's expenses. The sponsor of the trust, Gold Trust Services, believes that shares represent a cost-effective investment in gold. And now, the perspective also goes into the different structure of the trust and ETF itself, with the sponsor, the trustee, and the trust itself. That's not too important, I suppose, but it's incredibly nice how transparent this whole prospectus is, and it's actually kind of interesting if you want to continue to read. But moving on, the trust has trust objectives. They have ease and flexibility of investment and expenses. The sponsor expects that for many investors, costs associated with buying and selling the shares in the secondary market will be lower than the costs accounted with or associated with buying and selling gold bullion and insuring gold bullion in a traditional bullion account. Now, there's a section in the prospectus called risk factors, and most of them are pretty benign and trivial, but there's a couple paragraphs here that I just want to go over. It says the shares are designed to mirror as closely as possible to the performance of the price of gold, and the value of the shares relates directly to the value of the gold held by the trust, less the trust liabilities. The price of gold has fluctuated wildly over the past several years. Several factors affect the price of gold, including global supply and demand, which is influenced by factors such as forward selling by gold producers, purchases made by gold producers to unwind gold hedge positions, central bank purchases and sales, and production and cost levels in major gold producing countries such as South Africa, the United States, and Australia. Global or regional political, economic, or financial events and situations, investors' expectations with respect to the rate of inflation, currency exchange rates, interest rates, and investment and in trading activities of hedge funds and commodity funds. The shares have experienced significant price fluctuations. If gold continues to be subject to sharp fluctuations, this may result in potential losses if you need to sell your shares at a time when the price of gold is lower than it was when you made your investment. Even if you are able to hold shares for the long term, you may never experience a profit, since gold markets have historically experienced extended periods of flat or declining prices in addition to sharp fluctuations. So there's a whole bunch of stuff that you probably are acutely aware of. With us being so close to zero interest rates at the Fed fund rate, real interest rates are negative, essentially. And negative rates look terrible. Terrible, terrible, terrible if you're an investor. But if you think of as gold as a bond with a 0% coupon rate, zero is actually better than negative. Hence, gold's great run so far. I guess everyone has seen that the Fed was willing to go to very close to zero nominal interest rates, and it's happened. But this paragraph here, and the prospectus and risk factors, saying that historically there are extended periods of flat or declining prices, that is the ultimate dry snitch on themselves, saying, hey, don't expect great returns or even modest returns. You could be in this for a long time. Now there's speculation about gold going up due to, certain deliveries, physical deliveries of gold through banks. There's, of course, the election and other things that cause instability that make, gold look good. I really think you can't put too much cachet in one thing. But if you should invest in gold, I think the answer is a boomer yes. So definitely hold on to it for the long term, more than a year. I think, it's near the end of the run for this year, but going into next year, I'm fairly cautiously optimistic about gold. And, you can get exposure through gold either through ETFs like Spider, Gold Trust, GLD, or even some of the more leveraged miners like GDXJ. It's all the same to me if you're just buying shares as opposed instead of options. The implied volatility has already really outpaced, the potential risk reward scenario there. So I really wouldn't recommend options on any of those things. But again, I feel like there's just other things that you could put your money in right now, and hopefully I'll talk about that stuff in the future. And I feel like if you got in at the dip, if you get in on a dip at the beginning of the year when everything resets year to date, and then we restart the run, quote unquote, I think that would be the absolute best case scenario. But I don't think we're gonna crash after the election. I think if everyone expects that, I think we're more likely to crash before the market, before the election for some reason. But you can't predict these things. Time in the market beats timing the market. But it is more interesting to try to time the market, I admit. So, but hopefully next time we can talk about more pure equities. Let me know your thoughts in the comments about where you think gold will go and why. Talk to you guys next time.